Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in. All right, we're back. We are back with the Behind the Doors podcast with just Dan again today. Marvin's still out of town, but we have Leo Sanchez again. Leo, just quickly brief everybody on who you are and where you've been in case they missed our last episode with you. Just want them to be able to catch up. And then, guys, if you didn't catch the first episode, catch that one. We covered a ton there.
We did.
We're going to have a totally different kind of twist on this version of the episode, but still in line with kind of that larger institution. So
yeah, cool. Thanks, Dan. Thanks for having me again.
Of course, yeah. I mean, I'd be here by myself if Marvin just left me hanging, man.
Marvin left us today, but
yeah.
I'm certain he'll be back on here for the next episodes. But yeah, look, I'm excited to continue the conversation that we started in the last episode. And for those who are listening in who maybe didn't catch the first episode, I encourage you to listen to that if you have time. If not, I just want to brief you real quick and who I am. So my name is Leo Sanchez, and I'm the Chief Operating Officer for Easy Street Offers, and I've spent my whole career in the real estate space, and specifically the last about 15 years around Proptech and SFR space.
Yeah, awesome, man. A wealth of knowledge in the SFR, Proptech, all things real estate space. Yeah, it's funny now. There's not that many people that are in the business and have been in the business for 20-something years, right? When I tell people that now, they're just like, "Wow, you've been around a while," and I'm like, "Yeah, I've been doing this a long time."
There's a handful of us in the country,
right? Yeah, I've been around.
I think you and I probably know 80% of them.
Right.
There's not that many of us, but
not many left. No. All right. Well, let's get into the large investors kind of across the board in their sentiment currently in the real estate market. When they're thinking about buying, real estate's cyclical. It's there's good times and bad, and but historically over time, right, property values continue to increase, rents continue to increase
since the inception.
That's the game we all play. But right now, like with the big investors, right, we've heard is that for is it 36 months there was either a Fed increase of interest rates or they just kept them the same.
Yeah, it was 31 months.
31 months,
said that we know that, but yeah.
Yeah, so that obviously put the cost of capital out of reach for a lot of people, right? Or put investments out of reach, right? Properties didn't pencil. They didn't cash flow the way that they did once the cost of capital became up. But now that things are adjusting, where's the sentiment today? Where are you hearing that these guys are doing?
Yeah, look, I think it's no secret. Those who are listening, who are in the real estate space, or even if you're not, it's been choppy the last 31 months. Rates have increased, and what I would say is we're sitting here, we're filming this and recording this podcast. It's been 3 weeks to the date. Today is Wednesday. September 18th is when we saw a 50 basis point reduction in the Fed rate, which is some glimmer of light at the end of the tunnel. I know we've seen in our organization an increase in interest. Certainly the phones ring a lot more. We're excited for what's to come. It's certainly a step in the right direction, but we're not out of we're not out in the clear yet per se. No one's jumped in both feet first, but people are starting to kind of dip their toe in the water.
Yeah.
So I'm optimistic of what rates look like in the future and the direct impact that it has on our industry. But yeah, no, it's I think there's the sentiment is high for institutions and mom and pops alike. The interest rates impact, regardless of the size of investor that you are.
Right.
They impact your investment decisions without a doubt.
Yeah. It was funny. My wife is she's a real estate novice. Like she knows enough to be dangerous around the house. And, she asked me the question. She's like, well, what's changing? Like, why all of a sudden now is it more interesting, right? And I think like the layman's kind of answer that I gave her was, I said, well, consumers, like I read an article the other day that said that in 2023, 2024, less than 2.5% of the housing stock traded hands, which is like, that's just crazy low, right? That's just a crazy low number. But then you couple that with the fact that interest rates are ridiculously high. And like this third stat that I read was that more than half of the current mortgages in the United States are under 3.5%, right? So you've got a bunch of people that own their home and they're paying on a mortgage interest rate less than 3.5%. And then you're asking them to sell that house and trade it for a 7% interest rate.
And for a house that's a lot more expensive, right? They probably couldn't afford their own home.
Yeah, it appreciated,
Right.
36% over the last 4 years, right?
So we're asking them to go take out a new loan higher than their current loan at a higher interest rate. And it doesn't take a math genius to figure out why folks like aren't transacting right now.
No, yeah. Or are, but they're doing it very selectively, right? It's like very, very, very selectively. But, obviously things will change, right? And, so as we've started to have conversations more with the bigger players in the space, how are they starting to make those decisions of like when to dip your toe back in the market and when to start acquiring assets again? Because, like you and I were talking the other day, they've raised tons of money. Like I don't know that there's as much money, like
in history,
as much money like right now that's coming into the market than has ever been before, right? It's become so mainstream that they all have cash to deploy. But when do they? I mean, what's the decision to jump into a market?
Yeah, there's definitely a wall of capital, and I say that I'll answer that very generally because each institution or large investors' strategies is going to vary. But we're in the fourth quarter. Look, and you and I have been doing this. We talked about it for over 20 years, and in my 20 years, and same for you and anybody listening who's been in real estate. The fourth quarter is a cyclical time. It's a seasonality aspect of. Without everything that you just mentioned, the fourth quarter naturally, tends to drop 20 to 30% in transactions. And so we did see a reduction, but we saw it at a time when most institutions are pencils down. They're prepping for the following year, in our case, 2025. And they're getting their budgets ready. They're getting their investment strategy. So what I do know for a fact is, I happen to be personal friends with a lot of folks at these large institutions, just by way of my career, and we've developed big friendships. All of them are definitely are preparing and planning for what that deployment looks like. Again, the strategy varies by institution, but what I think we'll see is a lot of large institutions first quarter, second quarter come back into the space. And I think some of the signals, one is they were looking for a rate reduction. I think all the analysts, the guys that are much smarter than me, probably not than you, but
all these definitely smarter. Yeah,
all these analysts out there,
yeah.
they thought we were going to see like the odds, the money was on a 25 basis point reduction. I think it's clear that they knew that the Fed knew that they had to, to really make a statement and settle some folks as we head into the fourth quarter and just with the overall environment. So they went a little more aggressive, and they've signaled that the next rate reduction will probably be similar. And so what the large institutions want to see first and foremost is a rate cut, and then a second one will show them more certainty that we're a little more stable and we can have that's what the environment's going to look like. So that first one was huge. Cannot understate how big the 50 point basis reduction was in our interest rate. It was huge. It was a big deal. I mean, that same week, like my phone was ringing, our phone, we were talking to folks.
Yeah,
so
it's a lot better than when they were increasing it by 50 basis points like every day.
Yeah, nobody was calling me.
It seemed like every day it was happening, and I'm like, oh my gosh, is this ever going to end? Yeah, that's funny. And I think like what a lot of people maybe are questioning, right, is we always talk about yield, right? Like what is that investment going to yield you? Whether it's however you look at it, I don't care. It's a internal rate of return, a cash on cash return, a cap rate, whatever you want to talk about. That yield, whatever that return on that investment is, still makes sense, right? And a lot of people are going, well, why? Like how? How could it be that home prices went up, interest rates are up, and there's still a yield, right? And that third element out there that's floating, right, that maybe people haven't checked, right, to see what's actually going on is the rental rates, right? Those rental rates paced,
right? It kept up.
Yeah, right.
And it's still there's still a lot of runway there. You dropped a lot of statistics, at the beginning of this podcast, but another one that's I haven't seen the most recent study, but one that I saw from Goldman Sachs a few months ago was actually almost 70%, 70, more expensive to purchase home in today's environment than to go out and rent one. Right. And I bring that up because it just shows the amount of runway that rent has. There's still a lot of rent growth in the future. Right. Certainly it's moderated. Maybe it's not going to be like what we saw in COVID, but there's definitely a significant amount of room, even as rates decrease for rents to continue to increase, just kind of given the environment that we're in.
Yeah, I was talking to an executive the other day, and he asked me the question of like, he's like, well, I see rates, whatever, I get that, but what changes with that? Like what gets people off the fence, right? And that analogy of like my wife, and I gave him this layman's version of that, rang a bell with him too. And he's like, oh, so it, opens people up to trade again, right? Now people will start trading again. And I said, yeah, in the investment space, probably one of the most critical things that like we can measure is supply. Like what is the current market supply out there? Because even if like the market, like today in Phoenix, I think we're operating at something like a little over a 3-month supply. Texas, where you're at, you guys are like,
4.5 or something?
Yeah, a little over 4. And then we're starting to see like Florida creep up like a little in the high 4s. But I don't think there's a market in the country yet, maybe Las Vegas, where we're starting to see like a 5-month supply, right? And they tend to kind of fall first. But what's normal, like a normal market condition, I think that's what people like. It's been so long since we've had one.
What is normal?
Right? They go, well, like, what is normal? What's that? And 6 months is like statistically the norm, right? It's like that means that you've got open free trade. People can negotiate deals, like you can still make business happen, and neither or buyer or seller
has an advantage.
Is taking advantage of something.
There's an equilibrium, right? So it's right. That's economic. 6 months is what I've learned in my whole career, and I've heard folks reference, and we're not there in just about every market in the country.
No, but I think what is interesting too is that especially with the public funds, when you look at those guys and they're operating, because they're showing us their numbers, is their vacancy rates have never been lower. Never. Like it's like everybody's operating at 98, 97% occupancy on all of their assets, which is just crazy, right? It's like, so everybody's like, oh, nobody's going to pay these rents. Well, 97% of their portfolio, 98% of their portfolio is glad to pay it. They all pay it,
And they're all very happy to pay it, because if they went out and tried to buy, it cost them double, right?
Yeah.
So, yeah, no, you're right.
Yeah, that's tough, right? So, yeah. What about like in a season like this, right? So we've now been, I think, I don't know, maybe we've seen 3 or 4 of these like buy, turn it on, buy, turn it off cycles that, have been going on in the market.
A little bit of whiplash.
Yeah. And then now all of a sudden, like our friends are getting jobs again back at these things. But like operationally, what do these groups have to start thinking about, right? Because they're always property managing. That never stops, right? You always got to do that. But acquisitions is always very cyclical, right? And as they think about like operations now, is that changing, or they starting to scale up there? Are you starting to see some signals there?
Yes, and you're pulling on my heartstrings, as I've led a career in acquisitions, and so I've felt that faucet turning on and off, and I've got some PTSD, whiplash around buy everything you can and then don't buy at all. I've been in both of those environments. And what I can say with certainty is, sadly, a lot of these, a lot of big operators completely shut down their acquisition function, because They didn't see any light at the end of the tunnel and said, when it's time, we'll stand it back up. Some of them kept really lean teams. I think that's what most organizations did, was downsized it significantly. To downsize a team of maybe that was 50 down to 5. By cutting team sizes by 90% to kind of weather the storm, but to retain that talent and that legacy knowledge. So there's a mixture. But one thing for sure, and I can say this with confidence because I've had to turn the car on cold, if you will. Try to run water through the pipes again. Yeah. It's not easy. It takes 6 months to build a pipeline. So you're going to see these institutions as they start to jump in. They're all going to jump in together, which will be another interesting podcast that we'll talk about.
Right.
It's a different problem to solve, but we'll like that one. But they will all jump in, and they will all kind of all be back in at the same time, and they're all going to try to scale at the same time. And I'll say those institutions that retained that acquisition talent and that have some technology are going to be significantly ahead of those that are starting cold.
Is there an opportunity now, if you're like a retail mom and pop investor, to aggregate small portfolios and then be ready to sell when these guys start buying at the beginning of the year or at the end of this year?
Yeah. In my humble opinion, that actually opportunity has probably never been greater. So it's something that I like to say, and I've said it around the office, and maybe mentioned it in a couple emails. Maybe you've heard me say it. Is like don't fall in love with the asset, right? Marry the house. The house works because of X, because of Y, because of Z for you personally. The house isn't changing. That's a hard asset. It's a physical asset that lives in the built world. The interest rate, you date that. It's not a big deal. Your cost of capital is maybe higher, and you're willing to take some risk, and you're willing to take a 7% mortgage, but in 18 months it's going to be 5, sub 4, or whatever. No, probably not sub 4, but sub 5, low 4s. I don't have a crystal ball, but what you and I do know, and what I will bet, is that interest rates are going to be lower 1 year from today than they are today. And so the cost of capital, if it's a little higher, if it's $100 more a month on your debt service, so what? Right. Because the house is still appreciating at faster than that, right?
Yeah. Buy it now before it gets more expensive.
Yeah. Yes, yeah.
That's not changing. Right?
That's what I'm encouraging institutions, and not in a selfish way, because we have the platform, right? We have the technology to help these institutions who are starting cold, so that they don't have to start cold. We're starting with inventory, but I generally believe that with every fiber in my body that if you are in a position where you can acquire homes, do that. Yeah. Do that right now.
Yeah, it's an interesting play, right? To buy a few,
right.
5, 10, aggregate them, and portfolio sell.
Right.
Portfolio sell them to some of the bigger operators when they get back into the space, because to prime the pump, so to speak, that's how they get started, right? I remember that there was a fund that came here to Phoenix. I think now they're one of the big 6, right? So one of the biggest 6 in the country, and their principal was in the the storage space before,
okay.
right? So you probably know what I'm talking about.
Self-storage. Yeah.
And so they were in the self-storage space, and what he knew was that it was easier to buy like a portfolio than it was to start just buying one-offs, right? Because he knew that he needed property management and he needed all of these things, but until you got to scale,
right? It was expensive.
Now you're just like growing a team as you're aggregating, and so he had to come in and make a big splash right away. And they did. They bought a portfolio. It was like 3,700 doors right out of the gate, and that was their welcome to the world. This is what we do now. And, he bought the operations along with it, and that's how they started, which I thought was brilliant. Some of these guys start a little differently than that, but I just thought it was a good foundation to build from.
That, without a doubt, happens. I've seen that happen a dozen times in my career. You'll get a new entrant into the space that's got deep pockets. It's backed by some serious capital, and they need to come in, to your point, and make a splash. They need to have scale day one, or they'll aggregate a bunch of smaller portfolios and put something together. But I think the point that we want to drive here is that, like, for sure there is better days to come. I say for sure, nothing's certain, but in my opinion, not just mine, people much smarter. The environment is definitely getting better. And even if you don't sell, if the strategy was to hey, I'm going to aggregate some of these properties and I want to sell to one of these big institutions, and for whatever reason that doesn't happen, we still have a massive shortage in this country of homes, and you might be better off selling to an end
4
buyer
million,
anyways.
I think, is what HUD is like producing, right? The HUD secretary is saying it's something like 4 million homes is the current deficit
of shortage of houses that we need. And that's growing, right? And it continues to grow on the daily. And I've seen numbers as high as 9 million. The lowest I've seen is 3. So HUD, being a government entity, I think they're pretty credible. But still, 4 million homes. Where are they going to come from?
Yeah, builders are right? They're going to build some homes, right? But like public builder, like Lennar or Meritage, like how many homes do you think they build in a year nationally?
Well, I know D.R. Horton is the largest builder. And I at one point I know that number, but I feel like you probably know the number.
I don't. Honestly, I don't. I think that I've had guesses at the number before, but sometimes I'm like blown away.
Let's guess high. Let's say that the top 5 are building 200,000, which I think that's very high.
Right. Collectively,
it doesn't even put a dent on the 4 million, right?
Yeah, it's like as many people as that are coming into the country or turning of age to be able to purchase real estate.
Yep.
How do you sustain that, And then people go, well, home prices have gotten so high, affordability is the problem. Yeah, right, it is, but it's it's not a commodity. It's a scarcity. It's a scarce asset, and therefore it's going to yield some sort of a premium in order to get into the game, right? Otherwise, you're renting, and rent prices just continue to climb too, but it's for the same problem, right? Is that the housing stock is just low, right?
Right.
Yeah, and we're seeing builders get bullish, right? They're out there buying dirt, and they're buying it way out, and believing that they're going to develop projects miles from the city centers.
Look, they're not wrong. The data's there, right? The data doesn't lie.
Yeah, they're very strategic on where they buy. Yeah, there's no question. They're buying the right farms to put their projects on, for sure. Yeah, it's interesting. So before we flip to the mom and pop or anything, as these big institutions, I think it'd be interesting to just talk a little bit about how they evaluate an asset, right? You mentioned before that they don't take a emotional view of it, right? It's all math driven, or it's very subjective in how they look at it. But what does that even look like? How are they evaluating an asset?
Yeah, so most institutions look at things similar. They all have their own special sauce, if you will, of how they're calculating their yields. But at the end of the day, it doesn't get too complex. It's still pretty simple arithmetic. It's you've got a cost base, you've got a numerator, denominator, and you're coming up with your percentages. So that varies from institution to institution because their cost assumptions can vary. But at the asset level, they're looking at the rental, the potential rental income. So what do the comparables look like in the area? And a lot of institutions will only use their own comps. They have the benefit of having scale in certain markets where they've leased and they've kind of led the charge, and they've led the growth in certain markets, and they can charge a premium, rightfully so, because they're a professionally ran organization. These institutions are doing cool things now for their renters. They're reporting their rent to credit bureaus to help them out, and there's a lot of advantages to renting from an institution. So you can see, rightfully so, they can command a premium for their properties. And my point is some of those institutions, they only use their own comps, but only they have access to those comps, right? That's their own proprietary data set. So they're right. Unless you're working with Easy Street offers, and we can help in that area. But for the layman, for 99.8% of the population out there, they probably don't know what those institutions are leasing those properties for. And so that's a key number. First and foremost, you have to know how to underwrite rent, and it's not the same as underwriting a for sale comp. It's very different. I've worked with probably thousands of agents, and we've looked at how we view the world from how they're calculating their comps, and very few have really grasped how to comp a rent. So it starts with that rent number, and then it starts with all of their assumptions, all of their cost assumptions, and as I mentioned, those vary. Just like on our platform, we allow the mom and pop or institutions, we work with both of them, to modify those inputs so that the output that's coming out matches to what they're looking at. They're looking at apples to apples, right? And that's what's key, is because they all are using different assumptions. Yeah.
I think you bring up a good point, with rent alone, right? If you were just looking at rent and you didn't have enough information and maybe, like maybe I'll frame this differently. So I do think it's funny sometimes when someone tries to sell us a property for somebody, and they will say, well, I think it rents between $2,100 and $2,200 a month.
There's a big difference, right?
Like, it doesn't sound like a lot, right?
It's not.
It doesn't
to
sound,
you and I, and to probably anybody listening, like, well, what's the
Right.
big difference if it leases for $2,000 or $2,200? Sounds like a rounding error.
Yeah.
It's a material change in the value of that asset. Material, $25. Actually, I'll go as far as $5 is enough of a variance to somebody to move forward or not. A $5 difference in rent, Dan. And I know you know that, but for some of those that are listening, that was the biggest discrepancy when I was working for these institutions, and agents would send me properties. Is their rent underwriting? It's because it's not what they specialize in. It's
Well, they would get upset if we would, respond back to them and say, hey, look, like our numbers are different. We kind of got it at $2,100 a month, and they go, it's only $100 a month difference. Like, what's the big deal? So I'll pull up a model for them, and I'll go, this is a big deal. Like, this is the thing.
It's a no deal now.
Until you actually do the math and actually have figured it out, it's a significant difference. That's why, like, bumps in HOAs and, taxes that have gone up, or home insurance premiums and all of those things, like, as they all go up,
it's a big deal.
Rent's also got to go up, right? The landlord cannot absorb those things because the margins are super razor thin, right? Like, and I think that, like, the person that's not in this space a lot probably has like a totally different perspective, right? They're just like, they're seeing like private jets and, people flying around the world that are making millions and billions of dollars. Sure, if you own 100,000 homes, you're gonna make money, and you're gonna make a lot of it. But, if you're just a normal landlord, like, your margins are thin, and it's a thin margin game, and therefore, like, that $100 a month is a big deal. So, I think the kind of critical thing is just accuracy and data and information, which is why we lean so heavily into it. People ask me all the time, they're like, God, you're just like a nerd. You're such a stickler for these numbers, and I go, well, I've seen these models. Like, I've seen this go the wrong way, and when you go the wrong way, it's sideways. This deal no longer makes sense,
Numbers don't lie.
There's no friends and family deals, right? Like, you can't just like rent a place just to rent it, keep it occupied. That stuff drives me nuts.
When you talk about even the rent variance and how big of a material difference it can be, $100 that we talked about, it's the same for interest rates. Yeah. People say, like, well, that interest rate's only a quarter point, 25 basis points, or what's the big deal? They only dropped half a percentage point, Leo. Like, what's the big deal? It is a big deal when you're working with big numbers. It multiplies and it compounds. Like, it is a big deal. It translates to millions of dollars. Like, we're looking at rounding errors on a spreadsheet, but to an institution, it's a significant difference.
Yeah, I mean, even down to like, the property management expense, right? We're sticklers for like, how much are you paying for property management? Right. Of course, I want everybody to have a quality property manager, and they deserve to make money. But it's one of those variables that if you're paying, a 1 percentage point too high in property management, you've devalued your asset significantly. Right. And so I think, like, knowing those numbers and being diligent about those numbers, like, we see it at the institutional level, and they're like diligence freaks. But that mom and pop investor's got to have that same mentality, right? And they've got to be thinking that way, because if they're not, they actually are leaving money on the table.
They are.
Right?
Yeah, they're doing themselves a disservice. Yeah.
It's kind of wild. What about, like, fix and flip right now? I'm sure a lot of our investors fix and flip and are into fix and flip too. Like, what is your
fix and flip is interesting.
Fix it right now.
Yeah, it's interesting because on one hand, and you and I know this, is we're seeing fix and flip activity. It's out there. There's definitely people who are in the form of distress, or their property condition of their home, for whatever their personal circumstances are. It makes sense for them to sell to an investor, and they know that they're leaving money on the table, but they also recognize that it's going to take some money, it's going to take some effort, it's going to take some elbow grease to get the property to where it needs to be on the resale side. So we're actually seeing a lot of fix and flip opportunities, more than seen in the past in some markets. But at the same time, they're having the same issue that all of us are having. Is interest rates are high, right? And so you're underwrite. Everything can pencil. Everything can make money on a spreadsheet, always. But the execution is a whole other ball game, and we can't. There's controllable variables and there's uncontrollable ones, and right now there's a lot of uncertainty in this country, and there's less buyers for all the reasons that we've already talked about. But the demand on the flip side, some of the flippers we know, and I've had to take some smaller margins too, and not because of anything to do with the asset or the quality of work that they've done. Doing incredible work, probably better work than they've done in the past. Yeah, because they have to, right? But at the end of the day, when interest rates are what they are, it's not attainable for this. The pond got a lot smaller.
Yeah, no, I think that's a strong point. I mean, the other thing is like we have started to see the cost of construction materials come down a bit too. I'm kind of shopping some lumber for a build that I'm looking at now, and that price is about 25% lower than what I saw last summer at the same time. It's just lumber, right? So if I'm building a project or I'm renovating or something, and I can get cheaper building materials, like those are all positive signs. But then, now we've got the longshoremen, right? These guys all went on strike this week, and that honestly, of all things, like scares me the most. Is just that now the cost of renovation is gonna jump as a result. Because it's gonna be scarce for a while.
Impacts our logistics, right?
Yeah. So I hope they get this figured out. Those guys
I hope they do figure it out too.
Yeah, it's an interesting thing. Like obviously this is off topic, right? How they're doing this. We'll go down this little hole for a little bit, but I spent a little time educating myself on like this whole thing and what they're doing. So one of the reasons that they're striking and one of the demands that they want is that they want to be able to limit
AI, right?
Like
automation,
technology, right? They're worried about their long-term job growth, and can this industry sustain? Which I've never heard. Like I've never heard that like as a medical striking group or any of the groups that have gone.
One of the negotiating factors.
How do you even
technology,
negotiate for that?
Right?
Like how do you even begin? Like just say, okay, we're just never going to go technically advanced, and so that's a tough one. I think that I'm glad I'm not sitting in that negotiation room, to be honest. Like that,
100%.
That's a tough one.
Because I can see both sides of that coin, right? Like I can understand how people feel impacted by technology, but I also know all the benefits that we get from technology. So I'm in your camp, man. I'm glad that I'm not in that negotiating room, but I do hope it gets resolved. And some of the pay that they're looking at, I worry. Because the inflation has been out of control in this country, and we're giving folks doubling their pay. It has
they want a 70% increase.
Yeah, it has impacts, right? Somebody's got to pay.
Yeah, it's going to come from somewhere for sure. Yeah. Well, hopefully somebody's making that margin right now, and they can just like write the check. Because I don't want to be the guy that has to pay
both
70% more for my paint on my flip projects. That I don't want to do. Well, let's tie a bow on it. We've talked about a ton of institutional work. We've kind of covered a bunch of mom and pop stuff, and I think, the overarching sentiment is that the signals are good, right? But we're entering the last quarter of the year where you're going to have puts a lot of people on the sidelines. Like not a lot of people want to sell their home during the holidays, so that just becomes kind of a little bit of a quieter period. But like, if you're a real estate investor today, what are you doing in the fourth quarter? Like, how are you getting prepared? What are you doing? Yeah,
I'm buying, Dan. If I could, I'd be buying right now. Me personally, my personal strategies, I always try to buy in the fourth quarter. Most of the assets that I own on a personal level, if I didn't fall on my lap by some smoking deal, my strategy's always been to acquire in the fourth quarter. Aside from this interest rate environment, but knowing what we know, kind of insider information, if you will, that we offer to the folks that we work with. We know the demand is going to increase next year, so I would say now is the time to buy. But I'm not a financial advisor or anyone. Not telling anybody to they go seek their professional and the guidance that they need to make their decisions. But just a guy that's been in the space for 20 years and deployed billions of dollars. I've been involved in over 10,000 transactions. So
yeah, signals are good.
Yeah, signals are good. Best that I've seen in the last 3 years.
Yeah, signals are good. All right, man. Well, thanks for being on. We
Yeah.
really appreciate you coming in and
This was cool.
visiting us for a week. I know you're.
Maybe we can jump
living in
into this
Texas.
topic to see what happens when with the ports next time.
Yeah, hopefully we have some good news on
Yeah.
that one.
It was a fun conversation. Thanks,
All right,
Dan.
man. Thanks. Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.